To understand alternative investments, I think it's first helpful to explain what isn't an alternative. And traditional investments are usually considered to be things like stocks, bonds, cash, or cash equivalents, or things that hold a pool of those types of securities like mutual funds or ETFs. And alternatives are really anything outside of that definition, so things like hedge funds, private equity, farmland, art, commodities, coin collections, and the list could really go on. So now that we have defined alternatives, here's a few considerations to think about when considering this asset category. And the first would really be a benefit, and that's diversification. Many alternatives tend to have lower correlation to many traditional securities, which can help with portfolio diversification and potentially lower portfolio volatility. Another consideration would be transparency. Many alternatives tend to be largely unregulated, which makes them harder to monitor and review over time. And with any investment, you're always going to have to consider fees, and with alternatives, fees tend to be a little bit higher than traditional securities. Liquidity is another thing to think about. Most alternatives tend to have lower liquidity, or they're illiquid relative to traditional investments. And the last thing I'd mention is leverage. Many alternatives tend to have a broader use of leverage compared to traditional securities. We really do see the potential benefit for portfolio diversification, and over the last couple of years we did add an alternative to our investment lineup. And this was really a product of an important investment principle at our firm, which is to advance with science. And as the market continues to change, as there's new strategies that come available that hit on some of these considerations that we mentioned earlier, there are definitely things we continue to evaluate for client portfolios moving forward.